Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Peter Boockvar and Ira Harris. Peter is the Chief Investment Officer for the Bleakley Financial Group and Advisory at Bleakley, and he has a newsletter product called the Book Report. That's spelled BOOCKREPORT.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira is an independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also recently. Welcome, gentlemen.
Thank you, Rich.
Thank you, Rich.
Great. I thought we'd begin with a discussion on the current economic conditions and the trends going forth, given the challenges of the COVID shutdown and also extensive debt and deficit levels in the economy and in the financial system at both private and public levels. Just was wondering, what are your thoughts, Peter, on this? Do you see a stagflationary environment happening?
Well, right now I see the stag part as even with the economy reopening, the pace of growth is obviously going to be very modest. There'll be some areas of the economy that bounce back certainly a lot quicker than others. I'm sure when barbershops are fully reopened, they're going to have a very sharp bounce back in the pace of their business. Then on the other hand, obviously other areas like travel and tourism is going to be slow. So the stag part is there. I think we really won't know to what extent though until August, September, after most businesses are reopened. Obviously large gatherings like going to a baseball game or going to a concert are not going to happen until next year. But outside of that, most things by August, September will have reopened. And then that is when we can better assess the pace of growth. On the inflation part, I think right now we're seeing it in some spots. We saw it at the supermarket when you had all these supply issues, certainly on the meat side, and seeing it in some other areas. It's gotten more expensive to get truck capacity because there's been capacity taken offline, and what's left is you have to pay up for it. There's paying up for cargo because a lot of airlines that even flew passengers also did cargo. They've taken off a ton of capacity, so people are having to pay up for cargo. But on the other hand, obviously, when you get a collapse in demand, you're going to have companies that don't have any pricing power and are going to discount to get stuff off the shelves, particularly retailers that sell clothing. Obviously, the clothing companies have missed not just the spring season, but they probably missed a lot of the summer season in selling what they can at cut rate prices. But I do think the latter part of this year and into next year, that inflation part will begin to pick up because I think the demand side will come back quicker than the supply side. Now, I don't want to say quick, but quicker. The supply side is going to be still dealing with broken supply chains. You're going to have companies that are going to be very slow in bringing back the capacity that they shut down. Airlines are going to be slow in bringing back pilots and planes, even though demand, I think, progressively will pick up as this year and into next year continues. And then also you have all the monetary largest that's still out there. Now, you can say, well, the monetary largest was there 10 years ago. It didn't lead to inflation. But I think you have more supply-demand imbalance potential here because of what I just discussed on top of all that monetary largest. So I think we do have a setup for a stagflationary type environment at some point. I don't know if it's going to be, again, the stag is here. The inflation part may be more of a 2021 story. But you look at a lot of the inflation expectation surveys. The Fed came out with theirs yesterday, and we saw an increase to 3%. The Michigan Confidence Number, the Conference Board number, all seeing a sharp rise in one-year inflation expectations. So that'll be something to keep an eye on as well.
And your thoughts, Ira?
Well, I think that sums it up very well. From the trading perspective is where are the trades going to be with the most potential? Now, Peter and I have both been very bullish metals without the inflation. Are the metals heading up because of anticipation? I'm not. I believe that they more have to do with the central bank and the central bank action. And this tomorrow, being this is Tuesday, Wednesday, we'll get the FOMC statement and, of course, a press conference from Powell, although I don't know how much you can really talk about unless the Fed does some type of yield curve control, but we'll get into that. So, yes, but the question with the inflation is, and it's a question of, again, of policy. And Peter, of course, touches on it, which is what's the Fed going to do here? If inflation goes to 3, 4, 5%, whatever the number is, and unemployment is 10%, which I think is an optimistic outcome, especially drawing upon what Peter discussed about, which is all this capacity that is laid aside, because capacity in this time, don't forget, a lot of, the discussion about jobs for the last 6, 7, 8 years, even with the Trump tax cuts, there was, of course, a lack of CapEx spending, which in my analysis meant that firms were willing to take on workers rather than spend on capital expenditure, because, again, it's easier to get rid of workers than it is to get rid of a $100 million factory that you're stuck with. And we've seen this play out. Look at how fast firms got rid of workers, which is not a good thing. But that's what we're saddled with now. So you tell me, let's see, the election's in November, give me your best guess as to where unemployment is, December, January, February. And again, if it's at 9%, which I think is optimistic, and inflation is 4%, 5%, 6% by the most new measures, where does Fed policy go from there? That to me is what I'm looking at as we look out over the horizon.
And what do you make this week of the Japanese yen currency strength relative to the U.S. dollar? Is this something geopolitical related between North and South Korea or something else? Peter?
Well, the dollar has been pretty weak against pretty much everything. The dollar now is a stone's throw, where the dollar index, obviously Euro heavy dollar index, is a stone's throw from the weakest levels going back to 2018. If it falls below 95, which is where it was in March. So the dollar weakness against the yen is, just look at the euro getting above 113 and the pound at about getting closer to 130. And you have commodity currencies rallying as well, the Aussie dollar near 70 cents and the Canadian dollar. So there's broad dollar weakness everywhere. And part of that could be just the rebound in equities and people feel like sort of I can take the safety trade-off. But you also have exploding U.S. debts and deficits that theoretically is dollar negative and maybe now becoming reality.
And Ira, your thoughts?
Well, yesterday when I was chatting with the White Wave group, and we talked about the yen, because if you go back eight previous days, we had a substantial move, which I would deem corrective, and then it became more than a correction in the euro-yen cross, which we went from like 114.5 all the way up to 123 fairly quickly. So the dollar-yen actually went higher as the euro rallied about 3 or 4% against the dollar. Yesterday, the euro was down, but the yen and the Swiss franc, which had also corrected against the euro, the Swiss franc and the yen were both up. And that told me that this may well be the beginning of a major dollar move. I won't call it major yet because we have to take out some critical levels, but a significantly minor dollar move, which is a good thing. I think the Fed really wants, they'll never say it, but they would like to have a weaker dollar to go along with this because it would be the solidification of what they're trying to do here with all this stimulus. So the yen being up to, and it's up again today, pretty strong. Now the euro was weaker a little bit overnight, but it's rallied back. So you have the dollar down, except against the commodity currencies, but that's corrective too. So you're seeing, I view the recent overnight weakness in dollar yen and in dollar Swiss, because I don't think you can separate them right now, as being the incipient, the beginning of an incipient dollar move down. And as Peter points out, rightfully so. If you're enamored with U.S. policy, both fiscal and monetary at this point in time, you need your head examined. Yes, I know if you're an equity trader, it's great, and we can, because again, it solidifies the view that there's nowhere else to go. And there is truly nowhere else to go, because again, I do the litmus test that if I was sitting on a $10 million cash position and I was nervous about where things are, could I buy, would I? Could I? Of course I could. Would I buy a 1-year treasury to park in? Well, on $10 million, when you explain that to people that you'll make basically $18,000 for the year, that doesn't get anybody very excited. So you start to go out and search. So again, and I go back to the podcast Peter and I did with Rosenberg and Jimmy Bianco, the Four Horsemen. And we talked about the dollar there, but the dollar was rallying because there was a recognized shortage of dollars, especially for the emerging markets, who were carrying a lot and still are carrying a lot of dollar-denominated debt. But because of Peter's inflation view, which I think is starting to catch on around the world, there is people who are starting to move out of dollars going, it's just not the place to be. And I'm not saying this is going to be a one-way direct momentum, but I think it's the yen and the Swiss franc now catching up to what the euro has done in the previous 8-9 trading days that bears close watching here, especially with the Fed announcement tomorrow.
And what do you make of what's happening in Europe, Peter, in terms of the European Central Bank policy trends there and just overall economic conditions? Do you see also an emerging financial crisis coming out of Europe?
Well, you look at everything that Europe has been through between Greece in 2012, which then spilled over into Spain and Italy and Portugal, and then you had a rerun of Italy, and I'm not sure. A crisis is a tough word. It seems like that the ECB will try to eliminate the chances of a crisis, but at the same time destroying the bond market there, destroying the profitability of banks, which they've already done, and destroying any sense of normalcy. So it seems like Europe is always in some sort of crisis, I guess, whether it's on a country level or a regional level. And now they're trying to figure out how to implement or pass a 750 billion euro package where about 2/3 of that would be given in grants, the balance in loans, and how that would try to lift economic activity. I mean, I think the biggest problem for the ECB is where the Europe is that the ECB has created this epic bond bubble, and who knows how they would ever get out of that. You have the banks that are loaded up on sovereign bonds. What's going to happen to the European bond market if the ECB ever tries to get out of negative interest rates? It would be probably a disaster, which would then, I guess, pressure the ECB to buy even more bonds. They've just created a gigantic mess. I think it's just very difficult to try to game out how this plays out from here. Because God forbid they actually get the inflation that they want. What does that mean for rates in Europe and in the sovereign bond market and this massive bubble that's been created?
And Ira?
Yes, I think Peter's right on with that. But they have gotten themselves in so deep again. and we have to talk about this with all the central banks. There's no exit strategy. This is really significant, because the Draghi 2012, which has gone on and on and on, and exploded the balance sheet. Now it's exploding more, and it's interesting. Now you at least have some voices from Germany who I think are really starting to comprehend that. Hey, they're caught in this trap here. I really, again, you show me the way out of it, because with the amount of debt that's piled on the books of all the banks that Peter talks about, because they all own, especially as you're chasing yield, there are plenty of banks who bought Italian debt and Greek debt and French debt even, and Spanish, because you needed to have something, and they've stockpiled all this, and of course it'll all wind up through Target 2 back with the ECB regardless. They say it'll be the domestic banks, but the domestic banks can't, meaning Italian domestic banks, can't possibly cover that situation. So you are in a position you can't escape from. And people talk about, well, the German court. Yes, I know very well about the German court, but more importantly, and it's amazing how few people have discussed this, Peter and I have discussed this separately, is when Wolfgang Schleibel, over that weekend of May 23rd, 24th, and Memorial Day was the 25th of May, but Schleibel did a 180. There's no question about it. And as the president of the Bundestag, which makes him, from what I understand, the second most powerful person, because he controls the legislative agenda. And when he turned to support the Macron-Merkel initiative of 500 billion, 750 billion of pandemic bonds, and where what we call the Frugal Four, which was also been known as the Hanseatic League, said, well, no, they're going to be loans. And Schleibel said, no, the loans won't do them good. And it was very descriptive. He said, well, if you give them loans, that's like piling stones on top of them because they have so much debt. Schleibel said, make them grants. Yeah, I mean, this is like Nixon going to China in 1972. And yet it got very little play. Adam Tooze really picked it up nicely, which doesn't surprise me. But that was a critical juncture. And if you date it from May 24th, go look at what the DAX has done. Go look at the Euro has done. Go look at the S&Ps. That was a major, major event. And now more people in Germany are jumping on it because the Germans have to recognize better to control how this plays out rather than to keep threatening or going 999, because that's not going to get you anywhere. Because then if you keep saying no, you are going to get to a major crisis. Well, they've already had major crises. The nuclear option, so to speak, which is Germany pulling the plug on its guarantee of the ECB, the German credit card, as I like to refer to it, that will cause the major global deflationary depression situation because the banks will take such massive hits on the amount of sovereign debt that they own. And not just the banks, insurance companies, pension funds all over the globe. If you thought that the Lehman event was a global event, go ahead and have Germany pull the backstop on the ECB and watch what happens. There's no getting around it. And I think that Lagarde has finally made that point enough quietly. You got to give her a lot of credit. She is an owl. She is pursuing this without bluster and yelling, very dignified. And I think she is, when she got Schleibel to turn, and I believe that their relationship is close enough and he respects her enough that he listened very intently. And it's a critical moment. And look at the asset prices that we're talking about from that moment, and I think it's genuine.
In terms of what's happening from the post-COVID era, Peter, do you see a movement towards a more localized, decentralized economy, somewhat away from the globalization trend of the last several decades?
And not necessarily. I think if you're a big multinational based in the U.S., I think you want to have operations in Europe for your European business. You want to have operations in Asia for your Asian business. You want to have operations in South America for your South American business. I don't think you want to be using the U.S. as your pivot point to ship things all over the world. I think you want to really be localized. And I think maybe there will be some diversification of supply chains. Someone who relied too much on China may spread that out and get some stuff from Vietnam and some stuff from India and some stuff from South Korea and some stuff from China, rather than being very dependent on one particular area. Now, if there are some mission critical things that you need, well, maybe you will bring that back home and you will reshore that. That certainly is likely to happen. But I think it's going to be really a mixed bag. But I guess diversification of supply chains, I think, is more likely rather than just everything coming back to the U.S.
And your thoughts, Ira, on this?
I agree wholeheartedly. You know what? There's too much. I think what we're going to see is that the arbitrage of capital and labor, and it's really paying homage to Thomas Piketty, when he wrote his book, Capital in what, the 21st century, is that capital is going to stop having its way the way it's had for 30 years, and we're going to reverse some of that and moving the supply chains closer, as Peter talks about, whether it's Mexico, which I think is going to really get itself together, and that will be a big part of it. So the labor arbitrage will be less. Profits will therefore not be as robust. But I think the world will be a better place because of it, because I think U.S. corporate sold their souls knowingly. Again, let's go back to the early aughts when the books, one book after another, how to deal with over 1 billion Chinese consumers. Yeah, so everybody did the mad rush there, and I think they made some critical errors in order to get a piece of that pie. And I think we're going to roll that back. And that's one of the better aspects of what Trump has at least shined a light on. So I think Peter's analysis is 100% correct.
Mm-hmm. Let's move into a discussion on commodities, begin with copper. Peter, what are your thoughts on copper? Do you see it being driven by potential infrastructure spending or the post-COVID environment for using more copper as an antiviral metal?
I think from a demand perspective, copper actually has one of the more attractive profiles, as a lot of the call it the new economies type stuff, there's big demand for copper, whether it's electric vehicles. I think it's 5 to 7 times more copper is needed in an electric vehicle than a combustible engine vehicle. You have copper being used in solar panels and wind turbines and all these different secular drivers of growth that copper is going to be a key part of. Whereas before, more or less 20 years, copper's been the main growth driver has been China building apartments, whether people live in them or not. Certainly infrastructure like power grids and railways and stuff, that will certainly be a continuous growth driver for copper. But I find it attractive on the demand side. On the supply side, I think it's going into COVID, there was supply-demand imbalance where there was not enough supply. Obviously, that sort of balanced out with the drop in demand with this economic downturn. But I think as the global economy continues to improve over the next 6 to 12 months, that there could be some deficits in copper that is worth noting. And I'm a bull on copper.
And Ira?
Yeah. Well, Peter and I had this discussion, I think, when was it, Peter? Late February?
Yeah.
With silver and copper. So they've both risen in the face of a sense of industrial demand. And it is interesting because the news yesterday and today was that, of course, the Republicans in the Senate We're going to be less willing to do that $2 trillion next leg of the stimulus, and we're looking to cut it. But the real sad issue of it is, and we discussed this during that Four Horsemen of the Apocalypse, where I think Peter and I were in favor of Jimmy Bianco, that you would see some type of, or we needed to see some type of real infrastructure program in the United States, because that would be actually real investment with fiscal policy. The sad part is that they're not ready to go ahead with that now, because they should have been prepared. And this whole discussion from that, as far as I'm concerned, they've thrown a lot of money at this problem in a fiscal stimulus capacity, and now the whole thing should be a massive layout of roads, bridges, airports, railroads, green energy, which is heavily copper intensive, and we should be really pushing this, but of course they're nowhere to be found. And I agree, because it is going to happen. I would look to Europe to do, and I think the DAX is really trying to look at that too, going, hey, you got the Germans who came up yesterday or over the weekend with 130 billion stimulus. That's like squeezing what is that from Iraq? Blood from Iraq, and they're actually coming up with more. So I think you're going to see this, and it's going to be global in nature, because there's going to be a race for it. Interesting that Ron Barron came out and upped his price on Tesla 10 times, so he may be looking at some of the same stuff. But I think copper has a big story here. I know, Richard, you and I discussed that with that wonderful conversation with Louis Gavet a couple of weeks ago. Time flies when you're having fun in COVID. But I think that's 100% right. But I think more commodities, especially if my view on the dollar is right, because then commodities will become a repository of investment. So, it's like the only stocks that I've been buying for the last 4 or 5 weeks have been agricultural stocks, a couple of European banks, not the ones in the EU, by the way, but in Switzerland, and mining companies. So I think those are, if that is right, and I believe that Peter is very right about this, that those which are still underloved, when you talk about the big rally, airlines, hotels, the commodity sector, the producers are really underloved. Yeah, I know the bad story out of Argentina this morning with the nationalization of one of their biggest soybean crusher. There's always problems in that sector. But I think that the view that Peter projects is right, and especially in the metals, because you know what? Again, if you're at 10% unemployment, David Rosenberg.
Sorry, you're breaking up. Sounds like.
Oh, I'm sorry. David Rosenberg's fear was that there wouldn't be the workers to be able to do these infrastructure programs. Well, we certainly have no problem with finding the workers now, and those would actually be very good jobs, higher paying jobs, which will be needed to replace some of the lost airline jobs, some of the lost energy sector jobs, which are very high paying jobs. So it's really needed. So I make copper a very positive investment going forward.
And speaking of agriculture, are you bullish, Peter, on the ag sector, agricultural companies and agricultural commodities?
I am. I'm specifically been bullish on the fertilizer names, like Mosaic and Nutrien. I think that the demand side is very easy to predict in terms of the global demand for food on a perpetual increase. The supply side is more difficult because supply imbalances and excess supply and capacity cuts and mixing that all in, trying to figure out what the supply side is. But I do think that there is a bull case to be made for agriculture, and that's just one way of playing it.
And your thoughts, Ira, what is the best way for investing in the agriculture if food prices go higher? Is it through food processors or fertilizers, or your thoughts?
Well, my strength is not the equity analysis. I'm really much more top-down. And so I'll look at it, and it all depends how much leverage you want. But I look at companies as, I talked about with Mark Faber in one of these podcasts, Bunge, and Bunge's taken a severe hit, even though it's bounced back quite nicely. Archer Daniel, these have been coming global in nature, but have taken a hit. And I'm with Peter. I do own Nutrient, and Mosaic is high quality, but you get Deere and Caterpillar, Deere and Caterpillar will probably get you the double bang, because that will, of course, be with the big infrastructure projects. They'll have lots of work in the mining, and of course, they're in agriculture. So I think those are good places to look. But being that I'm much more acclimated to the futures, so I'll be looking to use more leverage via soybeans, and they still have not provided the technical picture. Although with the recent rally in the emerging market currencies, especially the Brazilian real has rallied back, and the Chinese have bought massive amounts of Brazilian beans, but they ought to have, because they were very, very cheap in terms of the Chinese yuan. In fact, in dollar terms, Brazilian farmers were getting paid record high. In Brazilian real terms, they were getting paid record highs for their soybeans, which led, hey, they sold everything, and the Chinese bought massive amounts. So I think it all sets up very well. Peter makes the case, food is food. The Chinese can make whatever noise about imports, but the Chinese need to feed that population, especially if the economy turns down. They do not want hungry, unemployed people in those urban areas. So there's a lot of bluster coming from the Chinese. I don't believe any of it, because food is just too important.
Your thoughts on gold and silver, Peter?
I remain very bullish on both. I think that if I'm right on the inflation side, we'll have falling real rates. Now you have the weakening dollar, which is very positive. I think there's a lot of catch-up that silver needs to do relative to gold. Now, obviously, silver with half the demand being industrial usage, and as the economy has obviously done what it's done, that's limited the demand for that side of the demand equation for silver. But I think as the economies around the world continue to reopen, that demand side will pick up. I think that, again, in this kind of world of monetary madness, I refer to it as, with negative rates, zero rates, all of the QE, that I think it's an important part of a portfolio. And I think that we will see higher prices as there's more monetization of global sovereign debt around the world. And if you throw in now a weaker dollar, it could be a good combination for the precious metals.
And Ira, your thoughts on gold and silver?
I think the gold is really one of these critical junctures here. I agree with everything Peter said, and probably then some. But the gold is interesting here because I'm comparing this to February, that time of 2013, when we also started to get somewhat of an equity rally, 2012, 2013, after the Europeans did, under Draghi, said whatever it would take. And everything, gold hit a wall as it tried to rally again up at 1650, 1660. And then it just looked, as I said, I was doing an interview, that it was a tired bull. And it got tired not only from the price action, but when the world became to believe that the central banks were able to contain. It was a containment of the great financial crisis. That then it was time to move into equities, and that's what you saw. This time, the gold is not really being affected by the rally in the equity markets. I mean, we've had a sizable rally here, but gold continues to sustain itself. I think that it held the critical area between 1650 and 1680. So we held that on the recent low. In fact, last week's low, even in the face of sustained equity market action. And if, excuse me, and if that continues, I believe that's a very bullish signal for gold. But I'll also, and we haven't gotten to this yet, but I guess I'll preempt it. Tomorrow we get the Fed announcement. And I think we need to talk about yield curve control, because depending upon how it's done, if the Fed keeps short to say, well, we're going to keep the 2-year, and I think Peter wrote about this morning. So he'll pick up on it, I'm sure. But if so let's say they keep, just like the Australians met Monday, and they're doing yield curve, or Monday? No, it was last week. My days are crazy, but they're doing yield curve control from 3 years and in by keeping these 3-year Australian at 25 basis points, if not lower. So if the Fed were to go that route and say we're going to keep the 2-year at, let's say, 25 or lower, and everything else would be left to its own, and the yield curve then would steepen, which we've seen a dramatic steepening because, you know, as Peter rightly talked about after the auction, I'm preempting him. I'm not going to do that. I'm going to let him talk about it. But somebody asked me a hypothetical. What if in a year interest, the 10-year went to 3.25? And my response back to him was, is the short overnight rate still at 25 basis points, 0 to 25? He said, well, I didn't think about it in that terms. Well, I said, I'm thinking about it in that terms. That would put the curve at 300 basis points. I said, how about this? Where do you think the dollar will be if the curve were allowed to do that? And he said, I don't know. I said, well, I'm willing to bet it would be 85 or under, and most probably well under, because if you want to really hurt the dollar, go ahead and steepen that curve. And we saw that last week when the curve steepened out quite a bit. And the usual noisemakers would have said, well, 10 years were up 20 basis points, 25 basis points for the week. Should have been good for the dollar. We know that didn't hold last week. Yes, I know bund rates, bund yields also went higher. Yes, they dropped from negative 45 to negative 30. So you're not comparing apples to apples, but I'll let Peter take over from there on the yield curve.
The issue I have with this yield curve control is, essentially we've had it everywhere, right? The Japanese have been explicit about it and keeping it within a tight range out to 10 years. But when you cut rates to 0, and saying that's going to stay there for a long time, and then that's its own form of control. The problem with telling the world that you're going to keep rates low for a long period of time, it actually does the exact opposite of what you intend to do. If your intention is to subsidize borrowers, well, then yeah, that's a good strategy. You're keeping rates low. But if your intention is to actually stimulate economic growth, it actually does the exact opposite, because the whole point of stimulus, whether it's fiscal or monetary, is to convince economic participants, whether it's a household or a business, to act today instead of waiting till tomorrow. It's telling a household, I'm going to lower rates, so I want you to buy that house today instead of saving up and buying it next week or next month or next year. Or I'm going to cut rates today, because I want you to buy that car today. I don't want you to wait. I don't want you to save money. I want you to borrow the money at a very low subsidized rate. Well, if you tell, that actually stimulates, because it brings forward economic activity. If you tell everyone that rates are going to stay low for a long period of time, you take away the impetus or any rush to act today. You just wait, because what's the rush if your central bank is telling you that rates are going to stay low for a long period of time? So I argue that economic activity actually slows on forward guidance, slows on any yield curve control. So I think the central banks have to be honest with us with what they want. Now, in their modeling, they think forward guidance is an economic stimulant, but we have plenty of evidence that it's completely failed in becoming that. It's only, again, been a stimulant to excessive borrowing at artificially low rates. So I'm not a fan. I think that the market, if we do get any inflation scare at all, if we do get a weaker dollar, which will be inherently inflationary, then yeah, you will get the steepening that Ira is talking about. To what extent we'll have to see, but that is going to be potentially a problem, because I only see a steepening like that if there's an inflation problem, and that's the last thing that the Fed's going to want to have to deal with. I mean, that's a central banker's worst nightmare, is a stagflationary type environment. And if we get that kind of a steepening, I think that's the type of environment that it's going to imply, because you can be damn sure that the Fed is going to take their time in raising short-term interest rates.
Interesting.
In order to address any inflationary pressures.
Which, if Peter's right, and believe me, I only broached that 300 basis point steepener as a theoretical construct, but that's why they'll come with yield curve control. And it's not that there aren't voices. And I agree with Peter every step of the way. It's a fool's errand. I know we both, if we were taking Bernanke's class at Princeton, we would have failed the class, because, of course, that would never hold. But that's why the Fed, it'll be important to listen tomorrow to see how much discussion there was around this. And if it's yield curve control, it will not be like Australia, but more like the way Japan did it, which is going out to maybe 10 or 20 years to ensure you don't get this move. I mean, we've seen a 30 basis point move, 35 basis point move, I think, over the last month in the 210 from 35 out to 70, which it went down to 35 on that weekend. So that's probably 7 or 8 weeks already, when Leo Brainerd was out talking quite a bit about it, and nobody was sure at what duration. Because, again, what Peter implies, what he does more imply, he says it, what I believe, it's because the Fed is afraid of the markets. It's a classic case of the Fed fears the markets, but they don't respect the market. They don't respect the signaling mechanism, but they fear it. And that puts them in a very difficult situation. And if you're trying to create inflation, which I believe that they are, because they think that they can ultimately contain it, but the policy outcome is to get inflation, because there's nothing that wipes out debt faster and easier than some inflation. And that's the danger. That's the danger of the world in which you live in. They would like to get some. And again, that's Rogoff's prescription from this time. It's different, is that, hey, if you ran 3 or 4 years of 6% inflation, it would go, and that was in 2011 or 10 when he wrote the book, it would do a great deal to alleviate the amount of debt overhang. So if that's their outcome, you are going to get it. But again, when Volcker wanted to squeeze inflation out of the system, the yield curve inverted to 600 basis points. In order to create inflation, how far does the curve have to steepen? That, to me, is the big question. And let's see if Peter will respond to that.
No, I agree. I think that's the question. That these central banks want to increase the rate of inflation with rates where they are. That should be the last thing that they should be rooting for, because of where policy is right now and what they're going to maybe be forced to do to address inflation, because they think inflation is just going to magically stop at 2%. And we'll see if that's the case.
Yeah, we'll see how it plays out. Very interesting and great insight, gentlemen. It's been a great discussion. How can our listeners learn more about your work, Peter?
They can check out bookreport.com, BOOCK report.com. And if they're interested in wealth management services, they can come to our website, bleakley.com, and reach out to us.
Great. And Ira?
Well, I've been writing notes from underground for 10 years plus, and it's been a joy, and I get to do these podcasts. But I'm actually trying to figure out how people are going to reach me, and I'm thinking about doing a half an hour to 45 minutes on a daily basis if I can figure out what time works for most people, and maybe through FRA and White Wave and a few other places to get these out there and make it totally interactive. And Peter and I will talk about this too. because he may have some ideas for me. But that's how they're going to interact, and to make it very timely. And again, it's much more for traders, although investors can glean quite a lot because we think big things, but we try to trade within it on a daily basis, but to give investable ideas. So I think there's a lot to be gained. So I'm still trying to figure this out because my confidant and proofreader and the one who I go to kick my tires hard is having a baby. So I'm not sure how long that will be a hiatus here, but we will be out there. We'll just have to figure out the best way to do it.
Okay, great. Thanks so much, gentlemen. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.